Okay, today we're going to talk about Chapter 13, which covers relevant cash flows and other topics in capital budgeting. And the other topics are primarily risk analysis. So we've already covered a little bit of capital budgeting in Chapter 12, but the difference here is that in Chapter 12, you were given the cash flows and simply asked to determine if an investment was acceptable or not. Now, in real life, nobody's going to give you the cash flows and say, hey, go calculate the NPV for me, because you can do that so easily on a computer or a calculator. So where you can add value is in determining what the cash flows are expected to be from the project. So the first thing that we have to do is to estimate those cash flows, and that's the topic of this chapter. Now, generally, we can classify these into three different categories. First of all, we have the initial outlay. That's the net upfront cost of the investment. Now, when I say net, that implies that something is being subtracted off. And so if you imagine, for example, that you're going to go buy a new car, well, you probably already own a car. And when you go buy the new one, you're either going to sell your current car or maybe trade it in. But the point is, whatever you get from your existing car is going to offset the cost of the new car. And that's what we care about, is that net upfront cost. Secondly, we have the annual after-tax cash flows. These are the ongoing annual operating cash flows from the investment. We'll see here in just a second. This is things like additional revenue and less expenses, and so on. And then finally, we have the terminal cash flow. These are the non-operating cash flows at the end of the life of the project. So at the beginning of the life of the project, we have the non-operating cash flows. Those are the initial outlay. But at the end, we also have some non-operating cash flows. That's the terminal cash flow. And I've drawn a little timeline here that hopefully gives you a little bit better idea of what we're talking about. So again, at period 0, you see IO for initial outlay. And then in years 1 through 5, we have annual after-tax operating cash flows. And then in the last year, year 5, we also, in addition to the after-tax cash flow that year, we also have some non-operating cash flows, the terminal cash flow. So the total cash flow in year 5 is the sum of the terminal cash flow and the after-tax cash flow from that year. Now, when we're thinking about the cash flows, we have to understand that some cash flows are relevant and others are irrelevant in capital budgeting. And obviously, we want to make sure that we include the relevant cash flows and ignore the irrelevant cash flows. So in order to be considered relevant in capital budgeting, the cash flows must be, first of all, incremental. That means over and above whatever cash flows the company currently has. Or if we think about this in terms of your personal life, imagine that you graduate and you get a job, and let's say that job pays you $50,000 per year. And then after a year or two, you start thinking that you could improve your life by getting a master's degree. And let's say that you think that after you have the master's degree, you'll earn $75,000 a year. Well, the relevant income in that case is just the additional $25,000. So whatever it costs you to get the graduate degree, that's your initial outlay. And then the benefit, or the after-tax cash flows, would be the $25,000 extra income that you expect each year on an after-tax basis, of course. Now, in addition to being incremental, the cash flows must also be after tax. And that, we've talked about this all semester. The government is always going to get their cut of any income. And therefore, what really is relevant is the after-tax income. We also have to ignore certain cash flows. And so the cash flows must not be what we call sunk costs. Now, a sunk cost is money that is spent prior to making the decision and that you cannot recover no matter what decision you make. So there's two factors in a sunk cost. You've spent the money before you made the decision about whether to make the investment or not, and regardless of what decision you make, you can't get that money back. And since you can't get it back and you've already spent it, it's totally irrelevant. Water under the bridge. Now, we also have to ignore any additional financing costs. This would be things like additional interest expense or additional dividends paid on common stock. Those cash flows are absolutely relevant to the decision. However, we are going to account for them when we calculate the present value of the cash flows. So the weighted average cost of capital represents those financing costs. So we don't want to include the cash flow and then discount those at the weighted average cost of capital, because we'd be double counting those financing costs, and that would make the project look worse than it is in reality. Okay, on this slide I'm going to give you some formulas to use to calculate each of the cash flows: the initial outlay, the after-tax cash flow, and the terminal cash flow. But understand, every project is different. And so this is, at best, a rough guideline as to how to do these calculations. Further, we're going to look at each of these in detail, so I'm not really going to discuss them here. But here's a formula for initial outlay, the after-tax cash flow. Now notice in this formula, by the way, that I have delta revenue, delta net expenses, delta depreciation. Delta stands for the change, and these are the incremental revenue, the incremental expenses, and the incremental depreciation. So remember, the cash flows must be incremental, and that's what that delta represents. And then finally, we have the terminal cash flow. Again, I'll talk about each of these here in just a second. So let's start with the initial outlay. So remember that the initial outlay is the net upfront cost of the investment. There can be a lot of things going on at the beginning of an investment. So clearly, you have to pay for the building or the machine or the car or whatever it is that you happen to be buying. So that's the cost of the investment. Very often there can be some shipping costs, maybe some cost to set it up. So if it's a big machine, maybe you have to hire a crew to put it together in your factory or whatever. There might be some training costs. For example, if you're purchasing a new computer system, you might have to train your employees on how to use the software. There can be an increase in net operating working capital. So let's think about this for a second. Imagine that you're going to buy a new machine and it's going to replace an existing machine. So for the existing machine, you had some inventory of raw materials, let's say. But the new machine maybe works more quickly, and therefore you're going to have to build up your investment in those raw materials. Well, that additional investment in the raw materials is an additional cost of this new machine. You wouldn't have to buy those new raw materials if you didn't buy the new machine. And so the cost of those raw materials is properly credited to this machine. So we have to add on any increase in net operating working capital. And then finally, if you are replacing some existing asset, then you have to account for the after-tax salvage value of whatever asset you are replacing. In other words, you're going to sell the existing asset and use the proceeds to reduce the cost of the new one. And we'll see here in just a minute how to calculate that after-tax salvage value. So here again is the formula for the initial outlay. So we have the cost of, let's say it's a machine, could be anything else, could be a building, could be land, it could be whatever. So the cost of the machine, plus any shipping, plus any installation costs, plus any training, minus the salvage value, less any taxes owed on that salvage value, plus the change in net operating working capital. Let's talk about that after-tax salvage value calculation a little bit. So whenever a firm sells an asset, there might be some tax consequences to doing that. And so we need to figure that out. And the way that we figure it out is pretty straightforward. We're simply going to take the salvage value minus the book value of the asset and then multiply the result by the tax rate, as you can see in the equation. Now remember, the book value of the asset is its original cost minus the accumulated depreciation. So again, it's salvage value minus book value times the tax rate. The idea here is if you sell an asset for more than its book value, essentially what that means is that you depreciated it too quickly. And when you depreciate something too quickly, you're going to get some tax savings. You're not going to pay as much in taxes as you should, and therefore the government wants that tax money back. If the salvage value is less than the book value, then you didn't depreciate it quickly enough and you missed out on some tax benefits that you should have had, and this is your chance to get them back. So let's look at a couple of examples of this formula. So let's say that we have an asset with a book value of $800 and it's sold for, actually my problem here is written incorrectly. So we have an asset with a book value of $800, and we're going to sell it for some amount. And we want to know what are the taxes and the after-tax salvage value if the tax rate is 21%. So imagine that we sell the asset for $800. That's exactly equal to its book value. So the taxable amount is zero. Therefore, the tax is zero. And if we take the $800 salvage value minus the zero taxes, we get $800. Now, if we sell the asset for, say, $1,000, then we take $1,000 minus the book value of $800, gives us a taxable amount of $200. The taxes on that would be $42. That's 21% of the $200. And then $1,000 minus the $42 in taxes gives us an after-tax salvage value of $958. If we sell the asset for less than the book value, say $700, then our taxable amount would be $700 minus $800 is negative $100. Multiply that by the tax rate of 21%, and we get a tax refund in a sense of $21. So our after-tax salvage value is $700 minus negative 21 is $721. Now, the annual after-tax cash flows are the incremental after-tax operating cash flows that are provided by the investment. Generally, these are going to fall into basically four categories. So first of all, we might have some additional or incremental income. This would be a cash inflow, so it's positive. We might have some savings. So for example, if we're buying a new machine, maybe it requires less maintenance than the old machine. So that would be a savings. Or there could be more expenses. Probably the new machine is going to have higher depreciation than the old one, and that additional depreciation is going to reduce our tax bill. And so that savings due to the extra depreciation, remember, depreciation is a non-cash cash flow. So that money never actually goes anywhere, but what it does is it reduces our tax bill. And that tax savings is an important cash, usually inflow. And then there may be some other lost cash flows that we had from the original project that we no longer have or that are less now, and so we have to account for those. Here again is our formula. So essentially, think about this like kind of like an income statement. We'll see in just a second a way to lay this out like an income statement. But it's not really an income statement because remember, this is only operating cash flows. So we have the change in revenue minus the change in expenses, minus the change in depreciation. That gives us essentially EBIT, earnings before interest and taxes. If we multiply that by 1 minus the tax rate, you'll recognize that as NOPAT, net operating profit after tax. And then again, because depreciation is a non-cash cash flow, that money never actually went anywhere, so we have to add it back on to get to operating cash flow after tax. Now, sometimes we also have to make additional investments in net operating working capital each year. And so we can subtract those off from the after-tax cash flow. That's the last term here. Now, one of the important calculations that we have to do is depreciation. So remember, when a business purchases an asset, generally speaking, they're not allowed to just write that off immediately. Instead, they have to depreciate it over the life of the asset. Now, the tax bill from 2017, the Tax Cut and Jobs Act of 2017, does allow some types of assets to be fully expensed in the first year. But we're not going to focus on that here. So we're going to assume that any asset that we purchase will be depreciated over some amount of time. The amount that we're allowed to depreciate is known as the depreciable basis. So basically, this is the cost of the asset plus any shipping and installation charges that we might have associated with it. So we're going to look at two depreciation methods. So first of all, straight line depreciation simply writes off an equal amount each year of the life of the asset. Now, in this method, what we do is we take a depreciable basis minus the expected salvage value and divide that by the life of the asset. So for example, suppose that we purchased an asset for $100,000. It will be depreciated down to a salvage value of $10,000 over its 3-year useful life. What is the annual straight line depreciation amount? Well, it'll be $100,000 minus $10,000 gives us $90,000 divided by 3 years will be $30,000 per year. And you can see that in the equation here. So straight line depreciation is easy to calculate But for tax purposes, most companies are going to use what's called MACRS. That is the Modified Accelerated Cost Recovery System. Now, this is a little more complicated. Not really, but it's a little bit more complicated than straight line depreciation, mainly because we have to do it each year because we're going to have a different amount each year. But what we will see is that with MACRS depreciation, we get more depreciation in the early years. That allows us to receive tax savings more quickly, and that makes the investment more attractive. Or in other words, we could say, well, the benefit to society of MACRS depreciation over straight line is that because we get these tax benefits more quickly, investments are more attractive than they otherwise would be. So we make more investments. That creates jobs and economic growth. Now, the rate at which we write off the value of the asset is specified by the IRS in these MACRS tables. So what they do is they tell you, based on what kind of an investment it is, you get a certain MACRS class. 3, 5, 7, 10, 15, or 20, and there's some other ones as well. And then they tell you the percentages that you can write off each year. So we'll see an example here in a minute of a 3-year asset, and you can see that we have 33.33% in year 1, 44.45% in year 2, and so on. Now, one thing to note is that regardless of what class the asset is in, there's always 1 year more of depreciation than the MACRS class. So in the 3-year class, there's actually 4 years worth of depreciation. In the 5-year class, there's 6 years worth of depreciation, and so on. The reason for this is that in order to reduce paperwork, essentially, the IRS assumes that you put the asset into service exactly halfway through the year. This is known as the half-year convention. And so that last year of depreciation really is just getting that last half a year. So let's look at an example. Basically, this is the same example that we had before. So we have an asset that we purchased for $100,000, and we're going to depreciate it down to a salvage value of $10,000 over its 3-year life. Now, it's in the MACRS 3-year class, but the thing is with MACRS depreciation, unlike straight line, is we depreciate that full $100,000, not the $100,000 minus the $10,000. Now, we may expect to sell it for $10,000 after 3 years, but that's irrelevant for MACRS depreciation. So if we go back to the table, notice in the 3-year class, we have, again, 33.33% in year 1, 44.45% in year 2, and so on. So what we're going to do is we're going to take that $100,000 times 33.33% for year 1, $100,000 times 44.45% for year 2, and so on for each of the years. So here's an example. You can see in year 1, our depreciation is $33,330. In year 2, it's $44,450. In year 3, $14,810. And in year 4, $7,410. Those are simply those percentages times the depreciable basis. And of course, you can see that the total is $100,000 because, again, we're depreciating the full amount. And these last couple of points simply expand on that just a little bit. Now, the terminal cash flow, remember, is the non-operating cash flows that happen at the end of the life of the project. So there can be several parts to the terminal cash flow, but basically 3. We have the salvage value of the new equipment that we're thinking about purchasing right now. In other words, say 5 years from now, we're going to sell this thing. And so whatever we think we're going to sell it for, less the taxes, would be our after-tax salvage value. There might be some costs associated with shutting down the project. So for example, if let's say you're running a mining project up in the mountains, well, when you're done, you're going to have to spend some money to clean up that mining site. Those would be the shutdown costs, and those are generally going to be tax deductible. And then we also have to recover the investment in net operating working capital. So at least at the beginning, and maybe throughout the life of this project, we've made incremental investments in net operating working capital. So in order to properly allocate costs, we have to imagine that we're going to recover all of that investment at the end of the life of this project. So if this was a big pile of raw materials, assume that we're going to sell those down at the end of the life of the project. In other words, we're going to get that money back. And here's our equation. right? So we have, first of all, the sum of the changes in net operating working capital. Generally, we assume that that's not going to be taxable because we're just getting back our original investment, minus any after-tax shutdown expenses, plus the salvage value, minus any taxes on that salvage value. Now, rather than using those formulas that I gave you for the initial outlay, the after-tax cash flow, and the terminal cash flow, a lot of times it's easier to lay this out in a slightly different format. Basically, we take those equations and instead of writing them from left to right, we rotate it and write them from the top to the bottom. And when we do that, we get something called an operating cash flow statement. And you can see an example here. This happens to be the cash flows from the mini case. So up at the very top, I have some kind of preliminary information. This is not really a part of the operating cash flow statement, but below that line, starting with revenues, that's our operating cash flow statement. So here, the way that I've laid this out, I have, in addition to the after-tax cash flows, I also have the initial outlay and the terminal cash flow in there. The bottom line, the annual after-tax cash flow, that's equivalent to what was given to you in Chapter 12. So all of this work goes into calculating those cash flows. And from those, we can calculate the NPV and the IRR and the payback period and all of those measures that we talked about in Chapter 12. All right, so let's go through the mini case a little bit, and we'll calculate the initial outlay, the after-tax cash flow, and the terminal cash flow. So in the mini case, it said that Shreve's Casting Company is considering adding a new line to its product mix. The production line would be set up in unused space in the main plant. The invoice price would be $200,000. Another $10,000 in shipping charges would be required, and it would cost an additional $30,000 to install the equipment. So I've only included the relevant part here, the part that discusses the cash flows associated with the initial outlay. So here we have $200,000 plus $10,000 plus $30,000 gives us $240,000 for our initial outlay. Now, also note that this is a new project for this company. We're not replacing anything, so all of the cash flows are incremental. And in this case, there's no salvage value from some old machine or something because this is a completely brand new investment. And here again, you can see the formula for the initial outlay. Now, the after-tax cash flow is calculated next. And what we have from the mini case here is that the machinery has an economic life of 4 years, and Shreve's has obtained a special tax ruling that places the equipment in the maker's 3-year class. So that's for depreciation purposes. It goes on to say that the new line would generate incremental sales of 1,250 units per year for 4 years at a cost of $100 per unit in the first year, excluding depreciation. Each unit can be sold for $200 in the first year. The sales price and costs are both expected to increase by 3% per year due to inflation. We talked about that in Chapter 12. You have to account for inflation. Further, to handle the new line, the firm's net working capital would have to increase by an amount equal to 12% of sales revenues. And so each year, that net operating working capital is going to be 12% of whatever that year's, or the next year actually, sales is going to be. So we're going to increase our net operating working capital a little bit each year. The tax rate is 40%, and its overall cost of capital is 10%. So let's go through our operating cash flow statement, and here we're going to focus on years 1, 2, and 3, because year 0 is the initial outlay, and year 4 also includes the recovery of the net working capital and the after-tax salvage value, and those are components of the terminal cash flow. So notice in year 1, we sell 1,250 units at $200 a piece. That gives us revenue of $250,000. Our costs are $100 each, so 100 times 1,250 is $125,000. And then our depreciation expense, remember this is the 3-year class, is going to be 33.33% of that $240,000. That's $79,992. So if we take $250,000 minus $125,000 minus $79,992, we get $45,008. That's our essentially EBIT. Now remember, this is only operating cash flow, so there's no interest expense that we're going to include here. So this is EBIT, or our taxable income. Multiply that by the tax rate, which is 40%. We get taxes of $18,003. So $45,008 minus $18,003 gives us $27,005. So that is our after-tax cash flow. Well, not quite cash flow yet because we need to add back the depreciation expense, but we're almost there. Now, the way that I laid this out, I've included the increase in the net operating working capital. So you can see that in year 0, we took 12% of $250,000, gave us $30,000 initial investment. And then in year 1, our total investment in net operating working capital was $30,900. So the extra investment in year 1 was $900. That's where that came from. So if I take my after-tax income minus the $900 investment in net operating working capital and add back my depreciation of $79,992, I get a total cash flow in year 1 of $106,097. Now in year 2, we do exactly the same thing we did in year 1, right? We have 1,250 units times $200 a piece, but the 200 goes up by 3%, so that's going to be $206. So we get total revenue of $257,500. Our total costs will be $128,750. Depreciation, remember that was 44 point something percent. I don't recall the exact percentage, but we get $106,680. Our taxable income, EBIT, is $22,070. Subtract the taxes at 40%, and we get $13,242. Now, our additional investment in net operating working capital is $927, so we subtract that. We add back our $106,680 in depreciation, and we get $118,995. For year 3 and for year 4, you would do exactly the same types of calculations. Now, the terminal cash flow was included in that operating cash flow statement, okay, but we'll go over it separately here. So from the mini case, it said that the machinery is expected to have a salvage value of $25,000 after 4 years of use. Further, to handle the new line, the firm's net working capital would have to increase by an amount equal to 12% of sales revenues. We already talked about that. But remember, in the terminal cash flow, we're going to recover all of those investments. That would be the $30,000 plus the $900 plus the $927 plus the whatever the last year was. So we have 2 non-operating cash flows at the end of the project. We have the after-tax salvage value. Now, because we're using makers, the book value is 0. So the whole amount of that $25,000 is taxable. So $25,000 minus taxes at 40% leaves us with $15,000. That's the after-tax salvage value. Then we also have to recover the change in net operating working capital. Again, that's the sum of all of those investments in net operating working capital. So our formula is $25,000 minus the book value, which was 0, times 1 minus the tax rate, plus $30,000 plus $900 plus $927 plus $954.81. That was the $955 on the operating cash flow statement. Gives us a total terminal cash flow of $47,781. From there, we could calculate the NPV and the IRR and so on. Okay, now we're going to talk a little bit about incorporating risk into capital budgeting. We're not going to go into great detail here, but it's important that you understand, I think, a few things. So, first of all, recall from way back in Chapter 3, we talked about how investors are risk averse. And what that means is that they prefer less risk rather than more. So in order to get an investor to take more risk, you have to offer them a higher rate of return. Now, what that means for capital budgeting is that for riskier than average projects, we have to charge a higher than average rate of return. So the weighted average cost of capital is appropriate for average risk projects as a discount rate, but we need to increase that if we're looking at projects that are riskier than average, and maybe decrease it for projects that are less risky than average. So when we do this, when we add a risk premium on top of the weighted average cost of capital, We refer to that as the risk-adjusted discount rate, or RADR. So as an example, imagine that you're replacing an existing machine. Well, generally speaking, that's not a risky investment at all. And so we might have a 0% risk premium that we add on to the weighted average cost of capital. Or it could even be negative. So it could be negative 1%, something like that. But if you're launching a whole brand new product line, that tends to be a risky investment. And so maybe we add 3% onto the weighted average cost of capital to try to compensate for that risk. And the general idea is that as long as the project still has a positive net present value after adding on this risk premium, then it's a good investment. Unlike stocks and bonds, corporate projects are not traded all day, every day. In fact, they are rarely traded. And what that means is that we don't have a series of returns that we can calculate a standard deviation of. And so it's a little more difficult to get a handle on how risky a corporate investment is. But we do have a few techniques that we can use. So one of these is scenario analysis. And in scenario analysis, what we do is we have typically a best case and a worst case scenario, and this helps to give us an idea of the range of possible outcomes. We'll see an example here in a little bit. Sensitivity analysis is primarily used really as an input into scenario analysis. So with sensitivity analysis, what we do is we change one variable at a time. With scenario analysis, we change multiple variables all at once. So sensitivity analysis, what we do is we change one variable and we see how big of an impact that has on some profitability measure like NPV. The bigger the impact, the more important the variable is. And in our scenario analysis, we want to include only the important variables. And so sensitivity analysis helps to identify those variables. And then finally, we have Monte Carlo simulation. We'll see a kind of a little bit of an example of that. Monte Carlo simulation is kind of like scenario analysis on steroids. So basically what we do is we let the computer generate thousands of scenarios rather than the 3 or 4 that we might generate on our own. So let's look first at sensitivity analysis. So again, this is used to identify the most important of our uncertain variables. So we change one variable a little bit and we see how big of an impact that has on NPV. Then we put that variable back to where it was and we change another variable and we see how big of an impact that has on NPV. We do this for all of our uncertain variables. Now, here's an example from the mini case. So what I'm looking at here is unit sales, salvage value, and the cost of capital. And I change them by 10, 20, or 30% both ways. And then I can plot the results. So the chart that you see here is the NPV at those different change levels. The idea with this sensitivity chart is that the steeper the line, the more important the variable is. So the blue line, for example, is unit sales. And you can see that if we change unit sales by a little bit, NPV changes by a lot. So for example, if we decrease unit sales by 10%, NPV drops by, $24,000 or so. That's a pretty big change. It's almost 25%. But if you look at salvage value, if we drop that by 10%, it hardly has any impact at all on the NPV. So it turns out that salvage value is not very important, as you might expect, because it's out there 4 years in the future. And then weighted average cost of capital is somewhere in between, right? It's not as important as unit sales, but it's much more important than salvage value is. And you can see all of this on the table or in the chart, however you prefer to look at it. So out of these 3 variables, I would say we would do a scenario analysis with unit sales and cost of capital. We don't have to worry too much about salvage value. Now that we've identified the important variables, we can change both of them to create our scenarios. And the way that scenario analysis works is we'll set up usually 3, maybe 5 scenarios. So we might have, for example, a best case scenario, a base case scenario, and a worst case scenario. In the worst case, all variables are at their worst possible value. And in this case, that would be the lowest possible unit sales and the highest possible cost of capital. And then we'll calculate the NPV under those circumstances. The base case, or the expected case, everything is exactly where we expect it to be. And then in the best case, all of the variables are at their best possible values. So that would be the highest possible unit sales, the lowest possible cost of capital. And again, we're going to calculate an NPV for each of these, and that'll give us an idea of the range of possible outcomes. And so here you see a scenario summary from Excel, and you can see I have 3 scenarios. Poor acceptance, that's like a worst case. I have a base case, and I have excellent acceptance, that's like the best case. In the worst case, unit sales is 900 and the price is 160. Whereas in the excellent acceptance case, unit sales is 1600 and the price is 240. So you have high unit sales and a high price. And then you can see that I've calculated the NPV for each of these scenarios. Now, if you want, you can take this a step further and assign probabilities to each of these scenarios. And then from that, just like we did back in Chapter 2, you can calculate an expected value, standard deviation of the NPV, maybe coefficient of variation, and you can even calculate the probability that the NPV will end up being negative. And in this case, given that expected NPV and the standard deviation, it turns out that there's about a 19% chance that the NPV will be negative. In other words, there's about an 81% chance that it'll be positive. So it looks like a good project. Now, one of the problems with scenario analysis is that there's so few scenarios. So we're really looking at the extreme values, the very worst case and the very best case, both of which tend to be very unlikely. What Monte Carlo simulation does is it uses probability distributions for your uncertain variable, and then the computer draws random values from those probability distributions, and it plugs those into your model and calculates the NPV. And it does this maybe thousands of times. The advantage of this is that with so many scenarios, we have a much better understanding of the possible outcomes. And an added advantage is that it reduces uncertainty. The big disadvantage of Monte Carlo simulation is that we're never really sure that we're using the correct probability distributions. And you know the old saying, garbage in, garbage out. So if you use the wrong distributions, you're going to get wrong answers. And that may be worse than not doing the Monte Carlo simulation at all. Or that may be worse than just doing a scenario analysis. Still, it might be useful. Here's an example of a simulation that I ran on this project. I did 1,000 scenarios, and I assumed that unit sales would be normally distributed with a mean of 1,250 and a standard deviation of 175, and the unit price was also normally distributed with a mean of 200 and a standard deviation of 20. So I had the computer draw random numbers from both of those distributions, plug them into the model, and calculate NPVs, and it did this 1,000 times. In the end, what I found was that the expected net present value was a little less than 90,000. The standard deviation was about 57,000, and the probability of a negative NPV was 5.2%. Now remember, from my scenarios, I got about a 19% probability of a negative NPV. So by including all of these additional scenarios, I've reduced the uncertainty by quite a lot. Okay, so that's the lecture portion here. We'll take a few minutes, not very long, but a few minutes to go over the spreadsheet for the mini case. Okay, I want to take you quickly through the spreadsheet for this mini case. I don't want to spend a whole lot of time on this because we've pretty much gone over most of the important parts of the mini case. So up here in the upper left, you can see I have all of the inputs that were given in the problem, and there might be a couple of little calculations in there. And then in row 19, I also have the maximum acceptable payback period. I believe, could be wrong, but I believe I just made that up just to have a number for it. Then we have our calculation of the initial outlay and the annual after-tax cash flows, as well as the terminal cash flow. So recall that we set up an operating cash flow statement. Now, up here in the top portion, This is not really a part of the operating cash flow statement. This is simply kind of some preliminary calculations. So right here, I have the bulk of my initial outlay. So this is the invoice price, the shipping cost, and the installation cost. But then also recall that they need to have 12% of the following year's revenue in net working capital. So they're going to have to make an investment of 12% of $250,000, which is $30,000 in year 0. That's also a part of the initial outlay. So our total initial outlay is the 240, which was 200 plus 10,000 plus 30,000, and then plus another 30,000 in net working capital for a total of 270,000. Now I have it negative here because the Excel functions like to have a negative initial outlay. Then for year 1, I've calculated my revenues. Again, that's simply the unit sales times the price, which was $200 each. And then our cost was the unit sales times 100, which gives us 125,000. And then depreciation expense, remember we walked through how to calculate that. This would be 33.33% of the 240,000. The increase in net working capital is not a part of the depreciable base. Only the 240,000 is. So we need to be a little bit careful about that. And then revenue minus our fixed and variable costs minus our depreciation expense gives us EBIT, or I've called it taxable income here. Taxes are 40% of that. And then our after-tax income, this is not cash flow yet, but our after-tax income is $27,005. Now to that, we need to add our depreciation expense. And when we do that, we get our operating cash flow after tax. And the way that I've set this up is a little bit different than the way that I usually describe it, but over in this section here, you can see that would come to $106,997. Then we also need to subtract the increase in net working capital. Now remember, it's always 12% of the next year's revenue. So 12% of $257,500 is $30,900. And then what we care about is the additional investment. So we already invested $30,000. Now we need to have $30,900, so we have to invest in another $900. All in all, we have an after-tax cash flow of $106,097 in year 1. Years 2, 3, and 4, we do it exactly the same way. One difference in year 4 is that we have to account for the terminal cash flow. And remember, we went through this. The terminal cash flow is the recovery of the total investment in net operating working capital. And that's simply the sum of these numbers here. So that comes to $32,782 plus the after-tax salvage value of this new machine, or this, this new product line. So we can sell it for $25,000, but then we depreciated it down to 0. So the taxable amount is the full $25,000, and after taxes, that leaves us with $15,000. So our total terminal cash flow in this problem is $17,782. And then our total cash flow for year 4 is the after-tax operating cash flow plus that gives us $136,850. Now, using these cash flows, we can calculate our net present value, and you can see that that's positive $88,009.73, so we should accept the investment based on that. The IRR is 23.9%. We should accept based on that. And the modified IRR is 18.04%, so we should also accept based on that. And then the payback period is 2.48 years. And I'm saying to reject that because recall that I said the maximum acceptable payback period was 2 years. And I just made that up. But if that's the case, then we would reject this project. Now, we also did a sensitivity analysis. And you can see right here, this is our base case. Nothing has changed. That's what the 0% means. So we get 88,000 for our NPV for all 3 of our variables. But you can see if we reduce our variables by 10%, the NPV for unit sales drops from 88,000 down to about 64,000. That's a pretty big drop. The NPV based on a 10% drop in just the salvage value goes down to 86,985. That barely dropped at all, just a little over $1,000. And if we reduce the weighted average cost of capital by 10%, the NPV rises. Remember, the NPV and the cost of capital move in opposite directions. So if the cost of capital goes down, the NPV goes up. And it went up by a fair bit, a little over 8,000. So I said in this case that my two important variables were unit sales and the cost of capital. And then the chart is just these NPVs charted against these changes. And again, the steeper the line, the more important the variable is. We also looked at a scenario summary, and you can see that here. I'm not going to show you how to run that in Excel because this is not an Excel class, but that's the same thing that we had in the lecture portion. And then finally, here is the simulation. Now what you can see here is all 1,000, and actually I've hidden most of them, but all 1,000 NPVs, right? So we ran 1,000 trials that generated 1,000 possible NPVs, and that's these here. And then down here you can see we have the minimum and the maximum and the mean and so on, all of the statistics that we might want. And I've created a histogram of that and calculated the expected NPV, the standard deviation, and the probability that the NPV would be negative. So again, this spreadsheet is available on Blackboard, and I encourage you to download it and make sure that you can replicate all of these numbers. Okay, that'll do it for Chapter 13.